All right. Welcome, everybody, to Cultivating Clarity, Understanding Farm Taxes. I'm Jenna Neese. I'm the A&R educator with Purdue Extension in Putnam County, and I'm also with the Putnam County Soil and Water Conservation District. Um, I'm happy to have everyone join us. We'll hopefully have a few more joining us throughout tonight's presentation, but we are recording this to share with others. As we get started tonight, I do want to launch a short demographic poll. So I'll launch that now, and if you could answer it, that's great, but it is not mandatory. It's got three questions in it. The first one asks how many individuals are participating in your location. The second question asks was the race or ethnicity of the first individual viewing, and if you have a individual, you can in, designate their race or ethnicity in the third question. We're not going to ask if there's more than two, but if you could at least do that, that helps for some reporting issues. Um, and we'll do this for about a minute or so, and then we will get started because it thinks like most of us are done. Okay, so I'm going to end our poll. Thank you guys for doing that. So I'll have that for my reporting. But I'm really thrilled tonight to launch our first night of Cultivating Clarity. Tonight we have with us Michael Langemeyer. He is with Purdue University Center for Commercial Ag, and he will be our main speaker tonight so that you guys can listen to him to learn some about farm taxes and ask questions. So again, you can put questions in the chat, and we'll try to answer them throughout the evening. But I will turn things over to Michael.
Thanks, Jenna. I do have a cough and I'm dealing with some crud here, so I will periodically shut off my audio and so you don't have to hear that. A couple other housekeeping things. I coordinate the Purdue Tax School, which is a tax school primarily for CE credit for attorneys, certified financial planners, and CPAs. So that's one of the things I do. In that role, I often teach two or three of the chapters out of about a 15 chapter book. The Purdue Tax School is 15 hours, and so I've got two other instructors that also help me. So that's one of the things I do. I think Jenna might have said it, but in addition to sending the audio of this, she will also send my slides. I know I talk pretty fast sometimes, and some of these slides are fairly tough sledding, if you will. But as I indicated in the slides, I'm taking a lot of this or most of this from the Purdue or the Farmer's Tax Guide publication 225 of IRS, and I have that on a slide. That publication, and that's about a 100-page plus publication. So that's where a lot of my notes are coming from. Also, tonight we're going to focus on federal taxes, not Indiana taxes. I'm by no means an expert on federal taxes, but my knowledge of Indiana taxes is minimal. And so let's focus on questions related to federal taxes, if you will. Jen, I'm going to go ahead and share my slides,
Okay, sounds good.
and you should see them now. I'll
Yep,
get
we're
them
seeing
moved.
them in the work view.
Yeah, now it should be in the
Yep,
form
we're
I want
good.
it to be in. Okay, I'm moving things around here a little bit for myself. Okay, so I'm calling this tax planning for farmers. I updated this recently, but it's coming. Most of this is coming out of two sources. One is the Farmer's Tax Guide, which I think I have on the next slide, and then I also have some material coming out of a IRS publication on depreciation. So I've got quite a few topics that I want to talk about, but don't let this scare you too much. We're going to focus on about three different topics. Specifically, after I have a slide about accounting methods, that's pretty easy because well over 99% of all farms are cash basis for tax purposes. And so that works out quite nicely if you have Quick or QuickBooks or something like that. It's based on the cash records that you have, cash income and cash expenses. It also gives you a lot of flexibility in terms of how you handle income and how you handle expenses. And so that's extremely powerful benefit that farms get. And actually, all small businesses, if a business is under $25 million in sales, they can take advantage of reporting their taxes on a cash base using cash basis accounting. And so we'll talk about farm income. That's one of the huge mechanisms to control your net income for a given year. Then we'll talk about farm business expenses. That's also a key mechanism to control net income for a year, and I'll talk about how you can use different things in terms of farm income and farm business expenses to kind of control how much income you have in a year, which obviously would control your taxes. And then I have one slide on not-for-profit farming. That's sometimes referred to as hobby farming. I've got a couple pages in the Farmer's Tax Guide. I've got reference there. And so if you'd like more information on that, I've got those pages you can take a look at. But this comes up sometimes with part-time farms. If it looks like it's not run as a business, there's a lot of criteria there. There's probably 6 to 9 different points related to that topic. But if it look from an IRS's perspective, it looks like if you're not running a business, your taxation flexibility is nil. It's very small compared to what it would be if you're running the business as a farm, and so that has big consequences. And so I always cover that in presentations like this. And then we're going to get a little deeper dive into depreciation. To do that, I really got to talk about asset basis. I know that's not the most exciting topic you're ever going to run across, but it's real. I'm going to try to keep it fairly simple. But what we're trying to do there is we're trying to use the information related to how much we paid for an asset, and then our depreciation to come up with what we call an adjusted basis, which is used to calculate gain and losses, which is the disposition of property used in farming. And so that's the third main topic: income, expenses, and then I want to talk about depreciation, which are related to gains and losses in farms. Those are the three big topics that I want to hit on tonight, and we'll spend quite a bit of time, in particular, talking about depreciation. Partly because I like that topic, but it's an extremely important topic for small businesses because it provides a lot of flexibility in terms of controlling your taxes. Notice I never say minimize taxes. Tonight, I'm going to assume that your goal is not to minimize taxes, that your goal is to maximize after-tax net income or after-tax profit. And so I'll talk a little bit about that. But your goal should not be to just have no taxes in a given year, because that usually means that couple years I'll have no taxes, and then I don't have as many deductions another year because I don't want to buy maybe I don't want to buy assets because I can't afford to buy assets, and then I have a big income in another year. No. When you're looking at managing taxes, you want to kind of smooth out that cash flow or that net cash income over time. If you're working with an accountant or CPA, that's typically what they recommend. You don't go from zero income one year to 100,000 next year. You're going to pay more taxes if you do that. And so again, the goal is to kind of smooth out that net cash income. Don't pay any more than you have to. But always keep in mind, if you're making a decision to buy supplies or making a decision to buy an asset and depreciate, does this make sense economically to buy that asset? Do the benefits from buying that new planter outweigh the cost of that new planter, where the benefits might include tax benefits, but don't just include tax benefits. They include a lot of other things too. And so that's probably enough said on that topic. But that's a very important assumption that I'm making there, that we're all interested in maximizing after-tax profit. So here's the two publications I'm gonna refer to. The first one is I'm drawing from very closely for most of the material. There is some information coming from publication 946. Make sure you have a lot of coffee in front of you if you're reading publication 946. Even a person like me that really likes to talk about depreciation finds that a very tough sledding read. It can be quite boring for most people. So that's just a reference. The publication 225 actually is written by ag economists. Many of my fellow colleagues that are coordinating tax schools and other universities helped write that publication. So that reads like an extension publication. It's long and it has a lot of detail. So it's not something you read cover to cover. But if you want to find a specific information on an expense or an income item or a basis of assets or depreciation or gain or loss, things like that, take a look at that publication. Extremely useful resource. And Jenna, please keep if I have some questions, let me know. I'll have you kind of watch that for me a little bit. But one of the things that Jenna asked me to cover, in addition to some things out of the publication 225 or the Farmer's Tax Guide, was tax rates. And so let's talk about that. When you talk about tax rates, I was trying to explain this. Excuse me. I was trying to explain this to a senior. She was writing a project related to taxes for different sized farms. And this gets pretty complicated pretty fast because there's not just one tax rate. So let me explain what I mean by that. There's really at least three different tax rates that really matter. So first of all, when you're thinking about a farm, some farms are sole proprietors, some farms are partnerships, some farms have an entity, an operating entity that might be a S corporation or a C corporation. Some of them have something's called a limited liability company. There's only one of those entities that I just referred to that has its own tax rate, and that's the C corporation. All the other business forms, sole proprietorship, partnership, LLC, S corporation, are what we call pass-through entities. CPAs just love to come up with these unique terms, and they call those pass-through entities. What that means is you're not taxed at the entity level. Your profits your profits go to the individuals that own the entity. And so if you have four different individuals, maybe they're brothers, maybe they're father, son, uncle, whatever the case may be, that maybe operate an S corporation as their operating entity, meaning that's their main corporation that they do business out of. What they'll do is they'll look at the profits at the end of the year, and then they'll pass those on to the individual. And so the individuals are taxed as individuals. So that's very important. Even C corp. Let me talk a little bit about C corporations, how that's different. C corporations, there's some farms that are C corporations, but it's pretty rare today to see farms that are C corporations. There was a lot of corporations formed in the early 70s that are C corporations. It's not quite as common today if you were picking an entity for you to be a C corporation. But the reason why I'm talking about this is C corporations have their own tax rate. And so if you have a C corporation as your operating entity or as your main business entity, that C corporation will be taxed at a rate. And then anything that goes to the owners of the C corporation will be taxed at individual tax rates. And so that's the only entity that we have, farms or small businesses, that's actually double taxation. All the other entities that we have are these pass-through entities where the taxes go to the individuals, and so these individual tax rates matter. If you take more profit out of your business, you're going to be at a higher individual tax rates. These are easy to find on the internet. If you search for tax rates for 25, for example, you can find these very easily. I'm just showing you one example here, but there's 10, 12%, 22%, 24%, 32%, 35%, and 37%. So those are our tax brackets. I'm just showing one as an example, but you can find the rates for all these, find the income ranges for all these tax brackets. And so the 22% tax rate, for example, applies to income, individual income, which could be farm income, could be income from investments, could be income from savings, whatever the case may be. Maybe a farm owns another business. It could be income from those other businesses. All this income is accumulated on the main tax form. We'll talk about Schedule F, which is the taxation, the form for the form for the farm. But all these different sources of income are accumulated, and these individual tax rates are applied to that accumulated income. And so if a person, this is married filing jointly. So if a married couple has income ranging from 96,951 to 206,700, the 22% tax rate applies to that income. Now, let's say a person had $96,955 worth of income. Should they be all worried that I need to somehow get rid of $5 worth of income because then I'm not in the 22% tax bracket? No. These are all marginal tax brackets. And so if I have $96,955 worth of income, only $5 gets taxed at the 22% rate. The rest of it would be taxed at the 10% and 12%. So remember that when we're dealing with income, it's all based on marginal rates. As you get into another tax bracket, only the amount above that income threshold, 96,951 in this case, is taxed at the 22% rate. That's an extremely important point. So let me pause there for that to sink in. You're not taxed on the average tax rate or my highest tax rate. You're taxed on a marginal basis. And so as you move into the higher bracket, a portion of your income is taxed at that higher bracket. And that's important because there's no magic for you to say, well, I want to be in the 12% bracket. And I'm going to be really worried if my income's slightly above what the 12% bracket and it gets into the 22% bracket because then I'm going to be the 22% tax rate. No, only that additional income past $96,951 is in that 22% tax bracket. Very important. And I used to teach, I didn't do it this semester because I'm doing more outreach these days, but I used to teach an introduction tax class. And that's one of the things I always have the students do is calculate their marginal tax rate. Based on all the different income brackets that they have. And that was a useful exercise to drive that point home. Now, for businesses, these self-employed tax rates are a bite. That's the only way to put it. Because an employee of Purdue University, or if I work for corporation ABC, I only really pay half of the self-employment tax rate. And so these self-employment tax rates are for small businesses or for businesses. But as if I was an employee working for someone else, I'd pay 6.2% as my tax rate, and I'd pay 1.45% on all income above on all income. That's actually the Medicare tax, and then my employee would pay the other half. Well, if you're a business like a farm or you own a restaurant or something like that, you have to pay the full amount. You are the employer and the employee. And so you pay 12.4% on all income up to 176,100. After that, you don't have to pay the 12.4%. That's the threshold, the current threshold for 25. It's adjusted for inflation every year. The 2.9% never ends. And so even billionaires are still paying Medicare tax on their income because that never there's no low threshold for the Medicare tax. And so both of those are important. And I found that farms and small businesses worry just about as much about the self-employment tax as the individual tax rate because that's pretty big. 12.4 plus 2.9. That's something you got to keep your eye on, and whether certain sources of income are subject to self-employment tax, certain sources of income are not subject to self-employment tax. And so that's one of the things we'll talk about when we talk about income. There's a source of income that's very important to keep in mind that's not subject to self-employment tax. And so that's why we do certain things on farms and small businesses that we perhaps wouldn't do otherwise because we're trying to mitigate the self-employment tax rates. Again, we're not minimizing taxes, but we don't want to pay more than our fair share either. And so we're trying to control the taxes. Now, the capital gains tax rates are lower than the individual tax rates, but also the thresholds are higher. And so to get into the 20% tax, you have to have income over 600,000. Not gain over 600,000, income over 600,000. So that 20% doesn't apply to a lot of people. And even the 15% bracket doesn't start till 96,701. And so if your income is below 96,700, the capital gains tax rate is zero. So let's pause there again. That's really important. That's one of the reasons why I'm talking about capital gains so much in this presentation. Not just because Michael likes to talk about capital gains. This is really, really important for business, for farms, because we invest in so many different assets that a lot of our taxes are in the forms of capital gains. And so if we could learn how to manage that to some extent, then we're going to pay lower tax. And so those are the tax rates. Accounting methods. Most farmers use cash method of accounting because they find it easier to keep records. Uh, this is a very important slide. These check marks are going to be our basis for what we're going to talk about here the next few minutes. We want to include gross income, all items of income you actually receive during the year. And so a lot of people, when they're looking at their marketing strategy for corn and soybeans, for example, are not only going to look at what is the price look like today compared to what the price might be in February or March. They're also thinking about taxes. Do I do even if the price is relatively good right now? Compared to what I think it's going to be in February, do I want to sell all my corn and soybeans before the first of the year? If you do, all that income is going to have to be reported in 2025. And so, this is one of the reasons why you see people space out their marketing. It's not just a marketing strategy, though that works fairly well from a controlling risk from a marketing strategy. And Jenna probably later on will plug a marketing program that Jenna and others are working on here. But it's not just a marketing strategy to spread out your sales; it's also a tax strategy. A lot of farmers will sell a portion of their crop in the fall and a portion of their crop after the first of the year to kind of spread out that gross income over 2 years. Now let's think about that. If I thought this was a low net income year, which it's going to be for a lot of grain producers, the price is not good right now so it's a little higher than it was, but the price is still relatively low. And so if I thought this was going to be a low net income year, would that change my marketing strategy? Possibly. Well, it might. Remember, I said one of the strategies for managing taxes is to make your cash flow net cash flow, um, spread that out and make it stable over time. Well, if I don't have a lot of income so far this year because my price wasn't real good for the crop I sold earlier this year, I'm just saying for instance, maybe I want to do some marketing here towards the end of the year so I can so I because maybe next year will be better. And next year, if I hold all my crop till next year, then maybe if I have a really good year next year, price is better, I have a good harvest, I might pay more taxes next year. And so one of the things you could do is you could accelerate some sales this year to kind of spread out that net cash flow. Again, that's the power of the cash method of accounting. It's so powerful to be able to use that to kind of control your cash income from one year to the next. The other thing that a lot of farms do, and this is really common, is if we think it's going to have a low net income year, and I have a couple slides at the end that refer to tax strategies for low net income and high net income years. And I think most of us are dealing with a low net income this year. But if you're a crop producer, if you're livestock, maybe you're dealing with a high income. But if you're dealing with a low net income and you typically buy supplies and seed corn and seed soybeans and these kinds of things in 25 for use in 26, maybe you want to not be quite as aggressive, buying supplies and various inputs in 25 because I don't need the deduction this year because it looks like I'm going to have a low net income year, and so you control when you buy the expenses. So that's also extremely powerful. The lender would call that prepaids. And so the lender is probably, if you're dealing with a lender, he's probably saying, keep track of your prepaids. That's what he's talking about. If you're buying seed corn for next year, if you're buying any feed or supplies for next year, whatever those supplies might be, you need to keep track of that because that's also a balance sheet item. You put that in your current assets because it's something that you own. You put money in, you invested money in it, and so it's a current asset. That's kind of an aside, but here we're talking about the fact that you might want to slow down the prepaids in 25 if you're expecting a low net income. If this was a high net income for a year, maybe you accelerate the prepaids a little bit. And so again, using the cash method accounting, I can kind of move the income around a little bit, and I also can move the expenses around a little bit. Extremely powerful. Now, one thing on the income that I don't have on a slide here, but it's very important, is you can't get a check from somebody. Maybe you did some custom work for somebody and they're finally paying you, or maybe it was harvest or something, and so they're settling up with you. You did some custom harvesting for someone and they're writing a check. You can't have the person write a check for December 15th and say, "Well, I'll just hold on to that check until January and I'll cash it." And then that income will be in 26. No. There's something called constructive receipt that's very important when you're dealing with income. And so if money was available to you in 25, it doesn't make any difference when you cash a check. If it was available to you, that's income for 25. That's getting a little bit beyond what I want to talk about tonight, but I did want to bring that up. For some of you that do a lot of shifting income from one year to the next, you probably want to look in the Farmer's Tax Guide for something called constructive receipt. It's discussed in more detail there, but that's what that means. You can't play games with that. Another example, let's say you forward contracted some grain, and it's going to be delivered January 15th, and you're not going to get the money until January 15th. That's 2026 income. So because that not constructively received until 26. And so it doesn't mean you can't have contracts or something like that. But if the money was available to you in 25, it's a 25 income item. The same with expenses. You need on these prepaids. One of the things that the IRS really frowns on is and hopefully this doesn't happen, but you go into a co-op or some other agribusiness and you say, well, I need some prepaids this year. I'm just going to write a check for $75,000. We'll fill out later what that was for. No, you need to be fairly specific on what that prepaid expense was for. If IRS comes a knocking, they don't like that, so they want you to. They don't mind the prepaids. Your cash basis. A cash basis accounting is your method of accounting for tax purposes, but they want it to be specific. I bought seed corn, I bought fertilizer, I bought feed, and just more specific on what it was. Another thing that sometimes gets people, and IRS frowns on this. I know it does happen once in a while. Is if I buy a used planter, for example, and you say, well, I don't really need the planter until next April, so don't worry about getting it to my place. I'm going to pay for it, so it's a 25 expense. Technically, that planter, regardless of when you're going to use it, needs to be on place in 25. Now that one's kind of tough sometimes, I know, but that's what we mean. That's what we mean by prepaid expense and constructive receipt and what year the expense goes with. And so there is some nuances to this, but it's extremely powerful. Don't think this is worrisome. This is extremely beneficial. Take advantage of it. You can move income around a little bit to stabilize your income. You can move the expenses around a little bit to stabilize your income. It's so extremely powerful. Use that to your advantage, and a lot of people do. So when we talk about farm income, there's a lot of different types of farm income. I've talked about constructive receipts. I don't even talk about that. There's only a couple of these I'm going to dwell on a little bit here. Obviously, there's sales of farm products. Anything we raise, or if we buy something and then resell it, if we buy some feeder livestock, that's an expense. If we sell that livestock later, that's a receipt, and so you pay taxes on the net in that case. And so sales of farm products, rents. I'll talk more about that. I'm assuming I have some landlords tonight in addition to operators. And so there's some nuances with respect to rental income from a landlord's perspective. And so I'm going to talk about that. Program payments, the year you receive those, that's the year they're recorded. Conservation reserve payments, the same way. Crop insurance and disaster payments, we have some flexibility on how those are reported. And so I'll talk a little bit about that. Patronage dividends, year of receipt, of course, cancellation of debt, year of receipt, custom work income, year of receipt. So let's talk a little bit more about rental income. This is from a landlord perspective, okay? The rent you receive for the use of your farmland is generally rental income, not farm income. And so I actually rent some ground to my brother in Nebraska. I'm not a farmer, so I don't record that on a Schedule F. That's rental income. There's some implications related to rental income, and so we'll talk a little bit about that. If you materially participate in farming operations on the land, the rent is farm income. And so a lot of people talk about material participation when they talk about rental income. And to put it in a nutshell, you really don't want to materially participate in farming because there's some advantages to not materially participating, and that's related to self-employment tax. And so that's why that comes up in this context. And what do I mean by material participation? There's a whole laundry list of material participation in the Farmer's Tax Guide um, that you can take a look at. But the main thing is as a landlord, I'm not making decisions. Even if it's a share lease, and I might have some suggestions, but I'm not the operator. I'm not making the decisions on what to plant, when to plant, what kind of fertilizer to put on, what kind of seed to use, what's the seeding rate. That's material participation. And so, as a landlord, even if you have a share lease, you're not making those decisions. You're not materially participating. And if you don't materially participate, that means the rental income is not included in self-employment income. Remember those rates for self-employment income? They're not tiny. 12.9% are 12.4% and 2.9% for Medicare. And so that's very important from a landlord's perspective is you don't materially participate, you're not making the decisions regardless of what type of rental arrangement it is, and then it's not subject to self-employment tax. So here's just another slide on that. Um, a general rule, income and deductions from rentals and from personal property leased with real estate aren't included in determining self-employment earnings. Exception, landlord materially participates. So I think I've talked about that quite a bit already. Um, but this was carefully worded here. This is rental of land, and that says personal property leased. What do I mean by personal property leased? The classic example here is if I was a retired farmer and I was leasing some land, and part of that land I was leasing was a farmstead that had some grain bins on it. I would want to rent the land with the grain bins because if I did that, then the rental income is not included in self-employment earnings. If I rent the land separate from the grain bins rental income will be subject to self-employment tax, 12.4%, 2.9%. And so that's a nuance there that's very important to keep in mind. That's why a lot of times we'll see grain bins and other things like that, including with leases of land. This is getting perhaps a little bit above and beyond where I wanted to go tonight, but I couldn't help myself. This is a situation primarily for a retired farmer that doesn't want to sell those machinery because, as we'll see here in a little bit, there's huge income tax ramifications of selling all your machinery right after you retire. IRS wants some of those deductions for depreciation back. So that's essentially what's happening there. And so then you decide, well, I'm gonna kind of sell the machinery over time, and then I'm gonna rent the machinery to someone else, while I'm doing that. And so that's the scenario here. This is kind of the retired farmer renting machinery to somebody else. If the machinery is rented with land, Schedule E, don't worry about that, but it's not subject to self-employment tax. That's the big one. Machinery rented without land rising to the level of a trade or business. This is likely the scenario if the retired farmer does not farm anymore. IRS is probably going to say, "Well, you're running a trade or business. You're renting machinery. You don't have a farm anymore. Um, you know, so it looks like you're renting machinery. You're in the business of renting machinery. In that case, it's subject to self-employment tax." They also have a third one here in the Farmer's Tax Guide. This is directly out of the Farmer's Tax Guide. Machinery rented without land, not rising to the level of trade or business. I'm not too sure this is going to pass mustard. I think the previous one's going to be the one that you're going to have to deal with. I excuse me. I don't have a farm anymore, and so I'm in the business of renting machinery, and so I'm going to have to pay self-employment tax on it. So you can talk to your accountant. I'm not too sure this one's going to pass mustard. The other one is you could machinery rented with land in a crop share arrangement. This is your grain bin scenario. So in addition to renting the land, I can rent the machinery with the land. In that case, it's reported in a different form, but it's not subject to self-employment tax. And so I know that was a lot uh, specifically related to machinery.
Michael, we did have one question that came in about machinery. They asked, does irrigation on farmland count as machinery?
Had to find my audio there again. Sorry.
That's
Um,
okay.
yes, that would typically be rented with the land also. Wells, pivots, yeah, those usually would be rented with the land too. That would be the way to do that. Like when I rent to my brother, it's a circle, and so he owns the pivot. Sometimes the landowner owns a pivot, but in this case, the operator owns a pivot, and I own the well. Part of the lease is the well, and so I lease him the well and the land. It's all part of the same lease. That happens to be a cash rent, but it doesn't make any difference cash rent or share rent. You want to include that with the land. Just a quick slide on weather-related livestock sales and crop insurance proceeds. I don't think crop insurance is going to be a huge issue this year, so but just in case it is down the road. You do have a little more flexibility with crop insurance. This is this is IRS guidelines, if you will. It's in the Farmer's Tax Guide. First of all, if you do have livestock and you got some payments related because of some weather, some natural disasters, things like that. I'm not going to talk about that in detail. There is possibility sometimes to defer those sales, either 1 year or 2 years. And not for the sale, to serve those payments. And so there is some provisions in there about deferring weather-related livestock sales. This occurs a lot in the Western Corn Belt. I was in Kansas a long time, and I'm from Nebraska, and a lot of times it would be drought, and you'd have to sell part of your cow herd or something like that, and you have income. How you report that, you can actually report some of that income, defer some of that income because you wouldn't have had to sell those cows if you wouldn't have had a drought. And so that's kind of the scenario you're talking about there. The crop insurance proceeds, if you use the cash method accounting, and you receive crop insurance proceeds in the same year the crops are damaged. I don't know how fast these payments are made, but if you had 25, crop insurance payment and it was paid in 25, is that 25 income? Um, Maybe. If you can show that under normal business practice, you would have included income from the damaged crops in the following year, this is related to yield, not price. But if you can claim that no, I wouldn't have I wouldn't I if I would have wouldn't have had this damage, I would have went ahead and sold that crop in March. If you can document that, it's possible to move that crop insurance proceeds that were received in 25 into 26. And so I don't expect you to remember all of that, but that's in the farmer's tax guide. This is a couple of issues that are taxed differently, and there is some possibilities of deferral of income. The constructive receipt does not apply to these items, and so I wanted to at least mention those. Farm business expenses. This is our prepaids. We're going to focus on prepaids a little bit, but here's the laundry list of different expenses. Don't to read those, but all your common inputs would be there. Um, Also, feed, of course. I don't have it on the list for some reason, but obviously, feed would also be in that list. So it'd be crop and livestock expenses. When you set up your chart of accounts and accounting in your software, I would make sure you set them up so it's really easy to summarize the data using the lines of a Schedule F. That's a lot of these items here are a line on the Schedule F. That's a very good way to do it because then it's very easy to take that information from your accounting program and put it on your Schedule F. Or if you're using an accountant, it's very easy for that accountant to take your information from your books and put it in Schedule F. If you save money for the accountant, guess what? Your bill's not as big. And so that's just a word of the wise. Now, if you wanted to separate out your fertilizer, lime, and chemicals in quite a bit of detail, you didn't want just one figure. Yeah, you can have account. You can have different accounts for fertilizer, lime, and chemicals. Just make it sure that there's a mechanism to kind of summarize that into a total that's fertilizer, lime, and chemicals. You can give that to your accountant, or you can use to put on the Schedule F. And so that's what I'm referring to there. Speaking of accounting programs, I'll just put a plug in here for one program that I'm familiar with. I'm not obviously not familiar with all programs. Quicken and QuickBooks are used a lot, but there's also a program used by the Farm Business Farm Management Association. They're in Illinois, but they're also in Indiana now, and they use something called PC Mars. That's a pretty good accrual accounting program, but it would also allow you to come up with summaries for the different expense items, which you're going to need to give your accountant, or you're going to need to transfer to your Schedule F. I'm going to focus on um, depreciation and just prepaids in general. So here I'm just listing them, but maybe some of these expenses, like maybe fertilizer, lime, and chemicals, maybe seed, um, maybe truck and car expenses, whatever. Maybe some of these items I bought in 25, I'm not going to use them until 26. Those are again called prepaids. And so, well, how do we deal with those prepaids? Well, first of all, you probably want to flag those because you want to put those in your balance sheet. Those are a current asset in your balance sheet, and your lender is going to want to know what those are. But you're going to want to, more importantly, you're going to want to know how those are. We're not talking about financial analysis today, but another workshop that Jenna and myself and others put on is talking about financial analysis, and you need those prepaids if you're going to calculate accrual net farm income. And so you want to keep track of those prepaids, and you probably should keep track of them by expense item. So here's just some basics on prepaids, just some rules of thumb here that are important. Prepaid farm supply is a pretty general list here: feed, seed, fertilizer, similar farm supplies not used or consumed during the year. I'm buying these in 25 for use in 26. That's by definition, that's what prepaid is. If you use the cash method of accounting to report your income and expenses, your deduction for prepaid farm supplies in the year you pay them may be limited to 50% of all your other deductible farm expenses of the year. That's a pretty big percentage. Even a smaller farm, you just have to watch it here a little bit. This usually doesn't apply to a larger farm, but but even if smaller farm, you can't buy every supply you're going to use in 26 and 25. That's going to raise a red flag. But you could buy a lot of supplies in 25 that you're going to use in 26. Again, use these judiciously. If you need some prepays to reduce some income in a year, go ahead and do that. If you have a low net income like year like this year, maybe you don't want to spend as much on prepaids this year because you'd rather have that expense coming in 26. That might be a higher income year. So use these judiciously, but there is some rules related here. You can't buy everything in 25 that you're going to use in 26. In particular, they really watch feed. And so if you have a small livestock operation, maybe you have some 4-H animals or something like that, be really careful with this. If you do get audited, they probably look at this one a little bit closer. Um, they want to make sure that you're purchasing feed, not a deposit. Again, it's that constructive receipt idea. The feed really needs to be delivered to your farm if you're going to expense it. And then they want to make sure it's for a business purpose. I mean, you can buy some feed ahead of time. The winter's coming on. I don't want to. I don't want to be caught without any feed. And so there's no reason why you can't buy some feed ahead of time. But you got to be a little careful with this. You can't buy all your feed for 26 and 25. It can't be a major distortion of your income. And again, they go on, the Farmer's Tax Guide goes on and talks a little bit more about this. I don't think we need to dwell on this, but if you use prepaids a lot, particularly the feed, take a look at that section of the Farmer's Tax Guide. One
So,
other um,
Michael,
one other item here. This is more of yeah, this is a deduction, but it's something that's been around for only a few years. And as far as I know, this is going to continue, but it applies to 25 certainly. So starting in 2018, this was part of the original Job and Tax Cut Act under the first Trump administration. There was a reduction in the tax rate for C corporations, and so they said, well, that doesn't seem fair that we reduce taxes for C corporations, but we didn't for these other entities. And so IRS said, okay, if you're not a C corporation, you can come up with this. You can do this qualified business income deduction. And so it was 20% of qualified business income is deducted from uh, sole proprietorship, S corporation, partnership, um, LLC, all these pass-through entities. That's not a C corporation. The C corporation got a lower tax rate. QBI is the net amount of qualified income and deduction items for the qualified trade or business. I had a slide in here about some items that were not included in qualified income. I took it out because I thought it was too much detail. There is some items that are not included in qualified business income. Gains and losses is one of those. And so I'm going to go through an example here. Brandon Smith earned $100,000 of qualified business income as a sole proprietor. He sold some land and recognized a $50,000 long-term capital gain. That's not included in qualified business income. So in other words, he can't get the deduction for that $50,000. He claimed $25,000 of itemized deductions, and his taxable income was $125,000. His taxable income adjusted for net capital gain was $75,000. That's his qualified business income. So his deduction is 75,000 times 20%. 20% is rather large. And so this is a pretty important deduction for small businesses. And that's kind of how that works. We calculate qualified business income and then we multiply that by 20%. Excuse me. This is your hobby farming information, not-for-profit farming. The factors are on pages 28 and 29. And essentially what this means, if you're not deemed to be a for-profit farm, um, for whatever reason, usually even part-time farms are considered farms, but if you have any questions about this, I would encourage you to look at pages 28 and 29 of the Farmer's Tax Guide, publication 225, because if it's deemed that you do not carry on your farming activity to make a profit, you report the income from this activity on Form 1040, and you can't deduct expenses because you're not a business, you're a hobby. And unfortunately, these expenses can also not be are not also not itemized deductions. And so you're income, but not the expenses. But again, like I said, there's not a lot of people fall into this, but it is an issue if you're not full time. It can be an issue. Uh, so if you're a part-time farm, take a look at those factors. You probably don't have to worry about this, but you probably should take a look at those anyway. Now I'm going to go through this a little bit quickly, but I want to go through what we call basis of assets and depreciation. So what is the basis? Essentially, this is the amount you paid for something. So if you buy a planter, $125,000, that's the basis. When we're looking at a capital gain, we look at the basis, what we paid for it, but we also look at something called the adjusted basis. And this is what we compare the sale price with to see if we have a capital gain. And I'll go through that. So what is this adjusted basis? The main thing that adjusts basis is depreciation. So we bought a planter for $125,000. Um, we held it for 5 years, and we had $100,000 worth of depreciation. So that's 125 minus 100,000 gives us a $25,000 adjusted basis when we sell it 5 years from now. That's going to be compared to the sale price to determine the capital gain or loss. If we sold that planter for $50,000, then we have a gain. If we almost had to give it away, we sold it for $5,000, then we have a loss. And so that's what we talk. That's why the adjusted basis is important. Is we use this to calculate capital gains and losses. So now let's get into depreciation. I'm not going to do a deep dive here, even though it might seem like I am. There's certain things you need to know about depreciation because remember, if we're the three different things, levers we can really use for in farm taxes or small business taxes are controlling income, controlling expense, and depreciation. We invest a lot in machinery and equipment, grain bins, pivots, wells, single-purpose barns, general purpose buildings, all that stuff's depreciated. And so to depreciate an asset, we have to own it. We have to use it in a trade or business. Farm has no problem there. It must have a determinable useful life. IRS helps with this. It must have a useful life that extends beyond the year you place it in service. Well, by definition, if something lasts 6 months, it's not a capital asset. It's not depreciated. It's expensed. So when does it begin? When you place it in service. So if you buy a planter on December 15th, it needs to be on the farm by the end of the year to be placed in service. So that's an example. You stop depreciating when either it's either fully recover your cost, adjusted basis is zero, or you retire the asset from service. I pull the plow behind the trees. That's retired from service. So one of the things, if you're looking for an accountant or you have an accountant, make sure they're doing a good job with your depreciation schedule. Keeping track of the assets, what were they purchased for, what's the depreciation, what's the adjusted basis. We need all that information to calculate gains and losses. So let's talk about depreciation a little bit. First of all, before we get the accelerated depreciation, we have what we call maker's depreciation, which is a modified accounting cost recovery system. So it has a full name. This started in the 1980s, so it's been around for a while. As of 12/31/17, all new machinery is 5-year property. Um, Used machinery is 7-year property. All assets placed in service right now have what they call a 200% declining balance depreciation. So they're accelerated depreciation. That's what that means. And the rates are given in the Farmer's Tax Guide and Publication 946. The depreciation book also has the depreciation rates. So 3, 5, 7, and 10-year property has 200% declining balance. 15-year and 20-year, or 15 years specifically, has 150%. Here's the different years of some of the common property. So new machinery, 5 years. Used machinery, 7 years. Fences, grain bins, 7 years. Single purpose agriculture structures, a swine barn, a greenhouse, single purpose. It's used for a greenhouse. It's used for my swine. It's 10 years. If you buy a general building that you put some 4-H goats in, you store some machinery in, maybe you store some hay in the barn, that's a farm building, general purpose. So more than one use, it's 20-year, useful life, slower depreciation. Um, Single use, 10 years. Um, Accelerated depreciation. Drainage tile, 15 years. Now let's get to what is truly accelerated depreciation. Section 179 expense is a expense deduction. So if I buy that planter for $125,000 and I have a lot of income this year, I could write off the entire $125,000. Now, do I necessarily want to do that? Well, it depends. If I have a lot of income, that might be a mechanism to reduce my taxable income. Again, but you want to say, does it make sense to buy that planter besides just the tax benefits? And so, is that planter something I really need? Is the benefits, including the tax benefits, outweigh the expenses? Because I have to pay for that planter. I probably have to borrow money for it. If I don't have to borrow money, I have to use my cash that I need for other purposes to buy the asset. So we always got to keep that in mind. But this is extremely aggressive under the one big beautiful bill. It increased to $2.5 million expense deduction in 2025. So you could buy machinery up to 2.5 million and write it off. Probably don't need to, but you could. There starts to be a phase out, or the phase out occurs at 4 million. So once you get above 2.5 million, it starts getting phased out. So this is what IRS considers smaller businesses, if you will. That's why it has the phase outs. Even though they in our vocabulary, that's not that small business that buys $2.5 million worth of stuff and expenses it. But that's what they're referring to as a smaller business. And Section 179 is very, very commonly used for small businesses. I've got an example here that'll drive that home. Bonus depreciation is also available, and this is a 100% write-off for qualifying property purchased and placed in service after January 19, 2025. Why January 19th? Must have been when the bill was cleared or something. Who knows why January 19th? This was the legislation. And so this is also very aggressive. This is probably more commonly used by C corporations, large businesses, because they have that phase out for Section 179. The bonus depreciation does not have a phase out. And again, think of these as if I have a lot of income, I can use I can use this Section 179 expense reduction to reduce my taxable income, pay less taxes, or I can use bonus depreciation to reduce my income, pay less taxes. Section 179, machinery and equipment, grain bins, single purpose agriculture, horticulture structures, irrigation pivots and wells, all of that stuff qualifies. Key requirements, it needs to be acquired by purchase. It can be new or used, not traded, not swapped with a relative, acquired by purchase. Used in an active trade or business, placed in service in the current year. So not real onerous requirements. Bonus. What's not covered by Section 179, general buildings, that's the 20-year property, is included in bonus depreciation, but you can also, these assets like pivots and wells and these kinds of things you can also use bonus depreciation on those. And so which one of these should I use? Hopefully I've convinced you that this could be a tax tool in years of real strong income. If we need to buy a planter, tractor, whatever the case may be, we can use these expense deductions, this accelerated depreciation, to reduce our taxable income. Again, we have to be able to afford to buy the asset, but these are available to us to reduce the taxable income. That's why these are talked about so much in the press. This year, a lot of farms are not buying very much machinery. Not that big issue, but I want to get this hour and a half I'm spending with you for all years, not just this year. And so when you have higher income, these can be extremely valuable. Or if it looks like maybe you have a livestock farm and you have some good income this year, sold some calves at a really high price, these are available. So Section 179, extremely powerful. And I want to go slow here. We can expense any part of the qualifying asset. What does that mean? If I buy something for $500,000, I buy a tractor, new or used, $500,000. Just making numbers up here. And I don't need expense deduction of $500,000. I can pick and choose how much I want to deduct of that 500,000. So in this example, I'm saying I just need 100,000. So I'm going to use Section 179 on $100,000 of the $500,000 purchase. The rest of that $400,000, I'm just going to use maker's depreciation. I'm going to set that up on a depreciation schedule and depreciate it over its useful life of 7 years if it's used, 5 years if it's new. That's extremely powerful because it helps you manage taxes down to a penny, if you will. And I'll give an example of that. The bonus depreciation is all or nothing. This is a problem. You cannot apply bonus depreciation to only a portion of its asset cost. And so if I buy something worth $500,000, that is the bonus depreciation option. That could put you below a net income that's negative. You don't necessarily want that, okay? You don't pay taxes, but that's not necessarily beneficial. Again, you probably want to more stable income that's above zero. Is probably your best bet. Typically, when you're trying to stabilize your income. And so also this applies to all assets in the same class with a useful life. And so it's not asset by asset. In this Section 179, if I bought another piece of machinery, I could say I don't want any Section 179 on this other piece of machinery. I won't use it for this other piece of machinery. I have that power. With bonus depreciation, I do not. If I purchase a new tractor and a new planter, both 5-year property, I have to take bonus depreciation on both assets and I have to take 100%. No choice. And so I always tell students and audiences like you that use Section 179. That's probably going to be your best bet, most powerful tool when you're trying to accelerate depreciation. So example two, Tim Lang has $250,000 in net cash income before depreciation. His goal is to have enough depreciation to create net farm profit of 25,000. Over time, he thinks that he can kind of get his net income down to about $25,000. Again, this is a scenario. That doesn't mean this is your goal. This is just the scenario for Tim. Tim's depreciation on assets acquired before 2025 is $125,000. So he's depreciating previous assets. He wants to buy $250,000 in 2025. So it could be new, could be used. If he does not elect out of bonus depreciation, he will have to expense the entire $250,000, leading to a net loss. That's probably not what he wants to do. So rather, we're not going to dwell on the math here. Trust me, it works. Um, Tim can elect out of bonus depreciation and elect to expense 62,500 under Section 179. So of that $250,000, he's going to expense 62,500, and then he's going to use maker's depreciation on the rest. After he's all, this takes a spreadsheet to do trial and error, trial and error. That's how I come up with his numbers. After all of this, he comes up with his net farm profit goal of 25,000. I wanted to get this example in there because even though it's a little complicated, it shows you the power of this accelerated depreciation when you're buying assets. Now let's talk briefly about gains and losses. Let me stop there. Is there any questions, Jenna?
One question we did have was, and you kind of touched on it, but are water lines and fencing something that can be depreciated?
Yeah, fencing can be depreciated 7 years.
And that's the only question at this point about, so if you want to move on, there's one that we can go back to at the end that we've
Okay,
already passed.
okay. Let's talk about gains and losses briefly, and I focus on briefly. So I talked about the sale price and adjusted basis. We're going to look at that adjusted basis, which is our original purchase price minus all this depreciation we've taken. Could be Section 179, could be bonus, could be this annual depreciation, which is maker's depreciation. That's all the maker's is it looks at 5 year useful life for a new machine and depreciates the machine over those 5 years. That's all that maker's does. And so I look at all that depreciation, different forms, and I come up with an adjusted basis that again should be on your depreciation schedule for every single asset. The amount you realize from the sale um, could be a gain or could be a loss. Kind of. And so the amount you receive for the sale, plus any fair market value of property or services you receive. Sometimes you sell an asset and there's some kind of trading going on or something. But let's just keep it simple. We're just selling something we bought 5 years ago. It's got a sale price, and we compare that to the adjusted basis. Is it positive? That's a gain. Is it negative? That's a loss. So when you dispose of property, your gain is treated as ordinary income or capital gain. The reason why I want to mention this is words that should put fear in anybody's mind that buys a lot of machinery is you got to be really careful when you sell it because if you use accelerated depreciation like Section 179 on a regular basis and you sell it too soon, IRS is going to say, now wait a minute. You wrote off all of this expense in 2023, and now you're selling it in 2025. I want some of that money back. That's called depreciation recapture. And so that's what we're going to talk about here in one or two slides. This is something you're going to have to take a look at tonight, but this isn't something you're gonna be able to remember necessarily. It's complicated. So you've got these slides here, and there's also discussion in the Farmer's Tax Guide in that publication 946, depreciation, how to depreciate property. You want the gain to be 1231 property. That's taxed as capital gain. However, when we have machinery, it could be classified as 1245 property. That is depreciation recapture. So that's all we're doing here. Don't worry about these section properties. It's talked a lot about in the text, and so I've got some slides here that basically talk about this. 1231 is something that's generally referred to. It's land. It's usually a portion of machinery that is not. There's usually when you sell a machine, usually a portion is depreciation and recapture, and the rest is taxed as ordinary gain as 1231 property. And so this is the property that has the lower capital gains rate. This is the property that has the higher tax rate because it's taxed as an ordinary income. Remember how low, how big a threshold or how much income you had to have those capital gains taxes? You want it to be taxed as a capital gain rather than ordinary income. 1245 is usually machinery and equipment is by far and away the best example, and that's what I'll use here in a couple examples. 1250 is buildings. We're not going to worry about those tonight. So this is some steps. I actually generated this with Google search. And so I typed in steps to compute depreciation recapture. And this is what it came up with. Sometimes I like this AI. And these are fairly straightforward. So let's just carefully walk through these. Determine the asset's original cost basis. So let's say we bought something for $125,000 3 years ago. That's the cost basis, $125,000. Calculate the total accumulated depreciation. We bought something in 23 for $125,000. Now we're sitting here in 25 at the end of 25. How much depreciation did we take? Did we take some Section 179? Did we take some bonus? Did we what was the maker's depreciation that we took? So we add all those together, and that's our total accumulated depreciation. Let's say it's $100,000. I'm going to give you two examples here, but let's just walk through an example as we go through this. So adjusted basis is that 125,000 minus my $100,000 of accumulated depreciation, which is Section 179, bonus depreciation, maker's depreciation, annual depreciation. So my adjusted basis is $25,000. Do I have a gain? Well, did I sell this piece of equipment for more than $25,000? If I did, I have a gain. If I did not, I have a loss. We're going to assume it's gain. Identify the depreciation recapture amount. Gain that is subject to depreciation recapture tax as ordinary income is the lesser of the total gain or total depreciation previously claimed. And you're saying, oh my goodness, just beat my head against the wall. What in the world is he talking about now? I'm going to go through two examples. Hopefully that'll clear that up. This is the definition. Hopefully that'll clear that up. But essentially what this means, step 5 means, is IRS can get greedy, but it can't tax you more than the depreciation you actually took. And so, for example, if the original cost was 125,000, the adjusted basis is 25,000, and for some reason this asset is worth a fortune today, we sell it for 150,000. They can't say depreciation recapture is 125,000. I only depreciated 100,000. And so sometimes if an asset holds its value, you only have to pay ordinary income depreciation recapture on the depreciated amount. Usually it's smaller because the sale price is less than the original cost. But as you know, if you have an older tractor or something like that, it probably has a sale price that's higher than the original cost. But the rule is here they can't claim depreciation recapture on more than the accumulated depreciation. And then any remaining capital gain that's not depreciation recapture is taxed as a capital gain at that lower rate. 0%, 15%, 20%. Depreciation recapture 10, 12, 22, 24, all the way up to 37. So two examples. I took this out of an Iowa State publication verbatim. So the sale price is $40,000. That's been pretty cheap asset. Original purchase price is $50,000. We had depreciation of $30,000. That's been maker's depreciation. We didn't use accelerate on this. Our adjusted basis is $20,000. So far, so good. Depreciation to recapture. Well, depreciation is $30,000, but our gain, I should have put the line in there. What's our gain? 40,000 minus 20,000. Make sure you see that. 40,000 minus 20,000 is the gain. They can't say the depreciation recapture uh, is 30,000 because we only made the gain's only $20,000 here, so only recapture $20,000 of the 30,000. So I have to pay ordinary income tax on that $20,000. Again, why did I have to do this? Because I sold the asset. I sold I took depreciation and I sold the asset for a relatively high value compared to its adjusted basis, and IRS just wants their money back. They want that depreciation money back. So that's what depreciation recapture is doing. This is a more common case. So same tractor, relatively cheap tractor, maybe really used. Sale price 60,000, original purchase price 50,000, accumulated depreciation 30,000, just like before. Adjusted basis still 20,000, just like before. Notice here the gain here, the total gain, not the capital gain, but the total gain is 60,000 minus 20,000, $40,000. So let's pause there, make sure you see that. $60,000 sale price minus adjusted basis, $40,000. Here's where that lesser of comes in. They could only recapture the accumulated depreciation. So $30,000 is the lesser of the total gain or accumulated depreciation. That's taxed as ordinary income. The other 10,000 is taxed at our capital gains rate. So if I made less than 96,700, it's 0%. That's how depreciation recapture works in a nutshell. Oh boy. But keep these slides handy. I think these two examples are really helpful to kind of think through what's going on here. And even though you have someone else maybe doing your taxes, it's really important to kind of understand what's going on here so you kind of know the ramifications of what you're doing when you sell assets. You realize that, yeah, I'm going to have some taxes due on selling these assets because I have some gains. And then some of that gain could be taxed as ordinary income. I need to think about that. Timing of sales and all of that stuff is important because remember, you can manage when you sell the asset. Do I sell the asset in 25 or do I sell the asset in 26? Again, you're controlling that income. A couple other things that sometimes come up. So I've gone through the big three: income, expenses, depreciation. Those are there's some other things, but those are the big three. Managing your income. Remember the constructive receipt. Manage your expenses, manage your prepaids. That's your expenses, and then depreciation, extremely powerful because if you buy a lot of assets, it's always something you need to think about. Do I want to accelerate the depreciation? Do I want to use just the annual depreciation? And it really matters what your needs are at the time. If you have income that's up and down, which a lot of farms do, some years are good, 21, 22, really strong income. This year, not so good, low income. You probably want to, in 21, 22, that's when you want to buy the machinery and that's when you can use the accelerated depreciation. That's why when you look at records like from University of Minnesota FinBin, the investment amounts in machinery are so variable because farms tend to buy machinery in those really good income years and then use accelerated depreciation. Extremely powerful. The Section 179 expense. Please make sure you understand what was going on here with my examples of Section 179 and take a look at that in the Farmer's Tax Guide. Extremely powerful tool to use for our tax planning. And the better you understand that, the better someone can help you with your tax strategies if someone else does your taxes. And so like-kind exchanges are very important in agriculture because this does not mean you don't necessarily ever recognize a gain or loss, but under certain conditions, we can defer the recognition of the gain or loss. This occurs with farmland. These are sometimes called Section 1031 exchanges. If someone sold some property close to a big city, They do a like-kind exchange on some other piece of ground, and they defer the gain. That's what they're doing here. This Section 1031 or these like-kind exchanges. So just one example here. Again, the amounts aren't huge here, but it brings the point home. Darnell Johnson owns 15 acres of farmland with a $10,000 basis. Pretty scrubby ground. And a $45,000 fair market value. So he bought this a while ago. It's increased to $45,000. In a Section 1031 exchange, like kind of exchange, Darnell sells the farmland for $45,000 and purchases 12 acres of farmland for $40,000. Now, notice right away that his amounts aren't the same. So he sells the farmland for $45,000 and purchases something, for $40,000. So there's $5,000 um, uh, difference there. Darnell has a realized economic gain. However, gain is recognized only on the amount of underlying property or cash received, which in his case is $5,000. He sold something for more than he bought it, so he gets the 12 acres of farmland plus $5,000. He has to pay taxes on the $5,000. The other amount, the other amount of the gain, which in this case would be the difference between the fair market value and the basis, is deferred. It's to be paid at a later time when he actually sells the new farmland. The basis of his new land is not very high. It's not what he bought it for. It's that old basis. And so what this tells you is if he wanted, if he turned around and sold that 12 acres relatively soon, he wouldn't have really saved anything because then he has to pay his basis is fairly low here. He still has to pay the capital gain. So this doesn't eliminate the gain. It just defers it. And so some landowners go from like kind exchange to like kind exchange to like kind exchange, defer those gains. There's I want to get through that. I want to talk about that low net income and high net income year. I'm assuming that whoever's going to talk to you next week is probably going to talk a little bit about entity considerations. I just have a publication here you can look at. Talks about different business forms. Um, I'm going to leave it at that. This is not the place for to talk about which entity is best for you, but there is some tax implications of different entities, and this publication goes through that. Estate taxes, again, I would think that the person next week's going to talk about portability and estate taxes. So I just have one slide on this. For a estate of a descendant dying in calendar year 2025, the basic exclusion amount is close to 14 million. And so if your estate's under 14 million, no taxes. 28 million for married couples. So that those thresholds go up by inflation. This was extremely a big deal in the one big beautiful bill. We were worried about, or people in general were worried about reducing these amounts, these thresholds. They actually kept them going, adjusted for inflation. So that was good news for those of us that help people with estate. Think about estate taxes. Portability, what does that mean? Allows the personal representative of a deceased spouse to make an election on the descendant's estate tax return to transfer or port the deceased spouse unused exclusion amount to the surviving spouse. This essentially defers the gain. And there's also something called step up in basis here that's hiding behind the scenes here. It's beyond where I want to go tonight to talk about that. That would take quite a while to talk about this in more detail. And the step up in basis, very important issue, but tonight I chose to talk about the big three mechanisms: income, expenses, and depreciation. So I want to just conclude here. I'll go through this rather quickly so we have a few more minutes for questions here. Managing income in a low net income year. What can I do? You can accelerate sales. You need if you need to stabilize income throughout time, you need to raise your income a little bit, sell more before the first of the year. You can reduce prepaid expenses. We talked about that. Um, you can adjust your Section 180 fertilizer expense. Have you look that up, but that's take into account the fertility that's in the soil. There's different ways to deduct that. So you can look at that. You might be able to defer the crop insurance or disaster payments or decide what you want to do with them. This year, if you got a crop insurance payment in 25, you probably want to record it in 25. So you need to think about that. The Commodity Credit Corporation loans. Again, we didn't get time to touch on that very much, but that's also something you can take a look at. You could capitalize repairs, and again, we didn't talk about that too much. Capitalize repairs rather than expense repairs. That's a whole nother issue. Whether you want to say the repairs last more than 1 year or you want to write them off in 1 year. You've got some decisions or choices you can make there. Look that up in the Farmer's Tax Guide if that's something that kind of interests you. And then, as we talked about, decelerate depreciation. If you do buy something, this is probably not the year for Section 179. Uh, if you have a low income, just use makers. Um, keep the depreciation relatively low. High income year. Um, if you have a high income year, this looks like it's going to be a really good year. Defer sales. Sell till after, wait to sell some things till after the first of the year. Prepay expenses a little more aggressively than you have in the past. Accelerate depreciation. Use Section 179. Retirement plan contributions. These are always a good way to think about. Some to always think about. Bunch itemized deductions. This is primarily related to charitable contributions. So if you think you have a really good year, maybe you can bump your charitable contributions that we're going to make in 26, make them in 25. So you have more itemized deductions. Self-employment tax planning. Use separate entity for real estate rented to farm operation. Let me talk a little bit about that. What a lot of farms do is they'll own the land as individuals, either personally or as a LLC. So they own the ground outside the operating entity, and then they rent the ground to the operating entity. And so let's say the land is owned by an LLC, different family members, and these family members, maybe some are on the farm, maybe some are not, they rent the ground to the operating entity, which which has everything but the land. Machinery's there, all the expenses, all the income are in this operating entity. Maybe it's an S corporation or another LLC. That's called the self-rental rule. The if you do that, you will not have to pay self-employment income on that rental income. So there's something the IRS carved out specifically related to that situation. So that's really important in every year, but particularly high net income years. Because again, those self-employment tax rates are pretty high because you have to pay both the as an employer and an employee. Another thing to think about, this is not necessarily in a high income year, but there is advantages of hiring your children. Um, they have a lower tax rate. You got to be a little careful there because if you just give them money or it's investment money, then there's something that's called the kiddie tax. But if they're actually doing something and you hire them, they're going to be taxed at a lower rate. And so that makes sense. If it looks like if you have a lot of income in a particular year. And so I wanted to close out with those two slides. Some things to think about in a low income year, some things to think about in a high net income year. I've done a lot of talking here, and so let's make sure that we address any remaining questions.
So we had one question come in so far that focused on prepaid expenses. They wanted to make sure they understood it. If you buy seed that you're going to use in 26, but you bought it in 25, is the cost for 25 not for 26?
Yes, you will deduct that seed in 25,
Okay.
and you will record that prepaid expense on your balance sheet on the ending balance sheet as a current asset.
Okay. Another question was, are children only taxed above a certain income level?
Yes, I don't know what the thresholds are on the top of my head, but just like it's the threshold for the 10%. And so if the income is below that 10%, where that 10% bracket starts, then they would pay no tax.
Okay.
That's assuming it's wage income. Now, if it's income, that's a different matter altogether.
So far, that's all the questions that have come in. Either we've answered them during or now. If anyone else has any questions, please feel free to type them in the chat. While we wait for any more questions, just want to say thank you to Michael for joining us today. Remind everyone that this was recorded, and I'll send out the recording and the copy of the PowerPoint in the email. Next week, we'll have Ruby Ward with us from Utah State University. It is the same link to join Zoom as we used tonight. So just so everyone is aware.
And I did not put my email on this slide, but if you look for the Center for Commercial Agriculture, my contact information is on there, and so feel free to ask me questions too. I know this is a lot to absorb, I definitely want to go through those big three, so you at least knew the ins and outs of those a little bit, the income, expenses, and depreciation. That was my goal, and you know, look at it some more. And if you still have some questions, just let me know.
Okay, we do have one that came in. It says LLC, if one owner is considered managing, but all four own land, etc., how is this handled? Is there self-employment for the person managing?
No, that's the beauty of this. It could be the same person. I could have two family members that have an operating entity, and it's the same two people that own the land. They rent to the operating entity. There's no rent. There's no self-employment on the rental income. Rental income LLC. There's a special carve out for rental income in this situation. It's not just for farms. One of the reasons why you see doctors sometimes own their own buildings, is they're doing the same thing. They own the building in an LLC and they rent to the practice. So this is just a tool that the IRS has allowed. That's a special carve out for rental income. So let's take advantage of it because it occurs a lot in agriculture. We do a lot of this self rental. It's called self rental. I it, it's he brings up a very important point. Him or her brings up a very important point. Is this is another beauty of this is it doesn't matter who the LLC that owns the land is. It could be the same people. It could be farm and non-farm people. That's the beauty of this. It works either way, and it's good for both parties. Both the farm people that are doing the operating entity and the non-farm partners. It works for both of them.
Okay, so it doesn't seem like we have any other questions. So again, thank you, Michael, for joining us. Thank you, everyone, for logging in. Please let us know if you have any questions and be safe if you've got to drive in any of the winter weather tomorrow morning or even tonight, because it sounds like it might be getting a little nasty out there. Have a good night. See you guys next week. Bye.
Bye.